This is Retirement Success with Steve and Elizabeth Holland and me, Todd M.J. Schnitt. For over 30 years, Steve and Elizabeth have been protecting your wealth or helping you create the retirement income that you need by creating inflation-adjusted, tax-advantaged, customized plans, because your retirement may be 20 to 30 years of unemployment. The Holland Group Retirement Wealth Advisors has the experience to take you to and through retirement. So let's make the rest of your life the best of your life. Welcome, everybody. Great to have you back. This is Retirement Success from the Holland Group Retirement Wealth Advisors. On today's episode, this question might sound very, very simple, but it's a little uncomfortable once you start to think about it. The question is, why do so many top mutual funds all own the exact same companies? If you've ever looked at your statement and thought, wow, I'm diversified, today this might challenge that assumption. Steve and Elizabeth, this is a goodie. Let's dive right in.
Yeah, I would say, MJ, the problem is diversification on paper and diversification in reality are not always the same thing. And, all these big companies, they're doing the exact same thing. They're owning the exact same companies.
Right. So, Steve, when you say to me, hey, how is that portfolio that you just spoke to, the man or woman, whoever it is? And I said to you, Steve, it's very diversified. It has a lot of this and that. And, some here, some there, percentage, That is not diversification, people. So listen, if you are approaching retirement, this matters more than ever because concentration on risk shows up right when people least expect it. And this is something that we do with every single portfolio. We take a look at the portfolio, do the risk analysis test among other different analysis to see where they are.
All right, let's discuss why this actually happens, whether it's good, bad, or both, and what investors should actually do about it.
So, back in the 80s, back in the 90s, back in the early 2000s, even 5 years ago, we have been using, since the late 80s, one of the companies we use is Morningstar. And a lot of people know what Morningstar is. And by the way, it's not where you buy frozen chicken nuggets. You can get frozen chicken nuggets from Morningstar if you go to Publix.
But wait a minute, is that a brand?
Yeah, it is.
It is?
Yeah.
Wow, okay.
So I was talking with a client one time, and I said, are you familiar with the company Morningstar? He goes, oh, yeah, they make great chicken nuggets. I'm like, ooh, not that one. So, Morningstar's been around since the late 80s, early 90s. They used to just analyze mutual funds. Today they analyze, of course, mutual funds, stocks, bonds, ETFs, pretty much everything you're going to find in a portfolio.
They should actually maybe analyze nuggets as well. They should have a new division to actually analyze and tell us the ingredients in all the nuggets, the good nuggets, the bad nuggets, the nuggets that have all kinds of added chemicals and ingredients and all kinds of chemical crap.
Chemicals. Yeah. Let's talk chemicals.
I think the nugget sales would drop in half if everybody knew that. That's for sure.
Oh,
but here's what we saw for so many decades: the top 50. The top 50 from Morningstar. The top 50 was always very, very different. Today, it's identical. Every single buddy wants to own NVIDIA. Every single buddy, or every single investor, I should say, wants to own Apple and Microsoft and Amazon and, of course, Alphabet, which is Google. This keeps happening. It doesn't matter if you're in a growth fund, if you're in a blue chip fund, if you're in a growth and income fund, if you're in a large cap fund. These are large cap companies and mega large companies, and we're finding the same thing over and over. The largest U.S. companies dominate the market. As of recent data, the top 10 companies in the S&P 500 make up roughly 30 to 33%, one-third, Elizabeth, of the index itself.
Wow. So we're talking about the same companies keep showing up. And the reason for that is it's often tech giants and large cap blue chips. Frequently, what we have seen, it appears that multiple mutual funds do what we call fund overlapping. So what does that mean? It's where the funds really share high performance, it's stable, high index, he's very indexed in the stock. This concentration also helps the money managers to really kind of overlap and talk about their performance. Top performance, hey, my stock is doing good. My portfolio is doing good. Index fund tracking is the same as benchmarking. This is what we look at for every single portfolio. We take a look across all large cap mutual funds, growth and value. You know, you almost always see the name. See, when you just mention it, what do we always see? Apple.
Same thing.
Right, Apple.
It's almost always Apple, Microsoft, NVIDIA, Amazon, and of course Google.
Yeah, Google. I mean, someone I just spoke with recently said to me, hey, I'd like you guys to analyze my portfolio, but I got to tell you something. I have some really great stocks that's doing really good that I am managing. And I said, just share it with me. Tell me what kind of stocks is it?
Right.
It's Google, it's NVIDIA, it's Apple, it's Microsoft.
Right. It's the same thing. We keep seeing it over and over. And then the big problem is people end up owning these companies like 5, 6, 7, 10 times.
Yes.
And that is not diversification. That's duplication. And that can be expensive.
Well, that's where we've discussed this many times, that you'll see some holdings that are like 20 or 30 times in a portfolio because it's all jammed into a mutual fund. What about Flicka Flacka Incorporated, which is a division of Fludge Cow Enterprises?
Yeah, I haven't seen that one in the top 50.
I think that's really going way, way down. It's in the toilet.
I think that's in the bottom 50.
Right.
Or
it's the bottom of the barrel.
Right.
Listen, so bottom line here is plain English. Nobody wants to be the manager who didn't own the so-called winners, is what it comes down to. Folks, are you overlapped? Sometimes ridiculously overlapped. Now, this show is called Retirement Success with the Holland Group Retirement Wealth Advisors. I'm MJ, Todd Schnitt, along with Steve and Elizabeth Holland. And we just want to make you aware on every show. We want to make you aware and educate you. And many people have no idea that they have ridiculous duplication in their portfolios. This is where a second opinion comes in remarkably handy. You call the Hollands. You say, hey, I'm listening to the radio show. Can you take a look at my current portfolio, my current investments? Yes, this is what the Hollands do. Complimentary, no obligation, no cost to you. There is no commitment. You call the office, or you go ahead and click on the link on the website. I'm going to give you all the information in a second, and just say, hey, Steve and Elizabeth Holland, Holland team, in the Tampa Bay area since 1993, a fiduciary firm acting in your best interests legally. They're bound as a fiduciary firm. Call up the Hollands, ask any questions, have them give you a complimentary review, a second opinion, and spell it out. Let you know if you are ridiculously duplicated. It is simple. You call the Hollands at 727-228-6449. That's 727-228-6449, 727-228-6449 for the Holland Group Retirement Wealth Advisors. Again, 727-228-6449. Or you can go to the website, askthehollands.com. All the contact information is on the website, but there's a very, very simple way to make initial contact with the Hollands. You can just click on the link at the very top of the page. You'll see at the very top the Holland Group Retirement Wealth Advisors logo. Right below that, there's like a goldish band right across the top of the screen, and you'll see click here for a discovery call. You click on that, you pick the time and the date. It's that convenient, and then the Hollands will be speaking with you and kind of get the ball rolling, have a conversation. Before you know it, they'll build you complimentary plans and show you what they would do differently with your investments, with your full retirement strategy. That's why I highly recommend that you make that call. Call the Hollands at 727-228-6449. What about closet indexing? Let's expose what closet indexing is all about. What does it mean?
Yeah, Elizabeth, let's come out of the closet, right?
No, I was thinking like a closet eater or something, you know.
Right. Yeah, very similar. Very similar, because they're doing something that they really don't disclose.
Right.
All
So
the time.
closet indexing are actively managed funds that closely shadow the market.
Right.
market benchmark.
But then they charge the actively managed price.
Yes, so Steve, so charging that active managed price is essentially provide index-like exposure at a higher premium cost.
Right.
So as you mentioned, it is for a higher price, and that's what it's called. Investors faces, a lower return, but guess what? Because the lack of active management, they don't really tell you, disclose to you what those fees are going to be. So this, for in reference to where the term closet indexing comes, the fund market itself as actively managed, but still holds 70 to 90% overlapping with index. MJ just mentioned it. There's so many money managers out there that really, talk about their performance, their great performance, but they have so much, like you mentioned, duplication in the portfolio.
I got to say something here that I think is going to help a lot of our listeners out there. You know that over the past 20, 30 years, I turned out a lot like my dad. I'm a perpetual reader. I'm always reading about the industry, always reading about what we do. And, right down the block from the office at Sunset Point, US 19, is Barnes & Noble. And I've been in there many, many times buying books over the years. One of the greatest books an investor can buy is a book called Take on the Street.
Oh, yeah.
It's written by Arthur Levitt. And Arthur Levitt was one of the longest running chairmen for the SEC. And when he retired, he wrote this book. It became a New York Times bestseller. But you know why I bought that book? Because of the chapter, How to Sleep as Well as Your Broker, which was very concerning. But in the beginning of the book, he says, sadly, most investors will fail because the mega large brokerage firms and the big, bad mutual fund companies, they have all the rules tilted in their favor. And talking about this this situation where we say closet indexing, we haven't gone into revenue sharing, we haven't gone into bury the losers, we haven't gone into all the other significant things that big mutual fund companies do, but the average investor is clueless. They have no idea this is even happening. So if you'd like a complete analysis on your portfolio and really have us dig deep and show you what you truly own and how it really works, I think that would be very, very important.
I thought you were going to break out into song, because when you said that you turned out a lot like your father, I thought you were going to break out into like the Harry Chapin song,
Oh, Cats in the Cradle.
Oh, yeah.
Right?
Absolutely. It's a great song.
It really is.
Remember the lyric?
It's pretty sad.
Yeah.
The lyric is, I want to be just like you, Dad. I want to be just, right?
Right.
Yeah, actually.
And the dad didn't have any time for his son. And
what's
guess
amazing?
What? The son turned out just like him.
Yeah. So, what's amazing? My kid is 21. College kid up in at NYU.
Right.
And he loves that song. So,
wow.
Yeah, I'm 21 years old. Maybe there is hope for the kidlets and children's today. Maybe there's a little hope.
Well, if I ever discover that I have a son, I'm going to be in big trouble, because Elizabeth and I have 2 daughters. We have 2 granddaughters, and that's it. So, well, actually, Ashton is our son, right?
Yeah, I would say that.
And that's as far as it goes.
All right, just a little bit more. Here we go.
Yeah, I'm gonna be like him.
All right, everybody now, let's go.
And the
Cats and the cradle and the silver spoon.
little boy blue and the man.
Elizabeth, I think it's your turn.
Yes, it is. And I'm going to have the mic all to myself because I don't need any help. So you know what? I just want to mention this. We're talking about this really important issue, that's closet indexing. And we talk about the fees and performance. We talk a little bit about the fees. The fees are high. Well, here's the reason why. I said the funds often underperform the benchmark after really accounting the fees, which is typically about 4 to 5 times higher than the passive index alternative.
Wow.
So
there's like 80% plus correlation, right?
Yes.
They're moving the same, so that there's not a lot of diversification and no defensive strategy thrown in there.
No, there really isn't. So this is why we're talking about this, and we really haven't really touched too much on closet indexing because this is something that we see it, we talk about other advisors doing it, and they don't explain what they're doing. So investors think that they're paying for skill, but they're often just paying more for the same ride. It's like your Uber Comfort. You know,
Uber Comfort?
Yeah, I know.
What's Uber Comfort?
So I like to have the Uber Deluxe.
Oh.
So what is that?
Well,
Wait, we're
pay a
paying
little.
more for Uber than we have
Steve,
to?
let me translate. You're paying more.
Oh, no.
I order. You have different options when you order the Uber. I order Uber Crap Wagon.
Well, you know what? Hey, I'm going to tell you something. We took an Uber about a month ago.
Yeah.
It was a kid driving this Uber, and basically, I don't know, Steve ordered it.
A kid? What was he in 10th grade?
He should have been.
I think so.
MJ, I opened the door, and it stunk of cigarette smell.
Oh, well, these days it could be marijuana.
Well, I don't know.
Did you put your cigarette out?
I don't smoke. But basically,
No, you're right. It did. It smelled terrible.
Wow.
And so you're saying there's different levels when because I hardly ever order the Uber. You do that. Alicia does that.
Yeah, I
Rachel
do.
does it.
Yeah.
But not that I'm trying to get out of paying for it. But so there's different levels that
yeah,
you can.
you get rated. I have a nice high rated, maybe because I give a good tip.
So what do you get with a better Uber ride?
So it's like Uber Comfort is an option where you can order an Uber and pay the premium. So the driver keeps an AC cooler on it.
Also, there are no glass shards on the seat
Oh gosh,
and roofing nails.
it's like the same ride, but it's a higher price for Uber Deluxe. I mean, I had a granddaughter with me. What do you want, Steve?
Oh, okay. So Alicia told me that you can also order these higher cost Ubers, and basically, what do? You tell the driver you don't want to talk to them?
I know.
Oh, that's true.
Oh,
Limited
I didn't know
conversation.
that.
Yeah.
I didn't know that.
So women can also request female drivers if they.
I
if
saw
they don't-
that.
Yeah.
So what is?
And if you don't want your driver to yak your head off, you just you ask for silence.
Really?
That's crazy.
It's on the app.
Wow.
Yeah. I mean, there are all
never
kinds
knew
of.
that.
I
would be worried.
I order no serial killer. I don't know about you guys.
That would be high on my list. That's for sure.
Folks, let me give you the number again. Call the Hollands. We do this show for one purpose. We do this show. I almost said we do this show for one person. No, we do it for many people. We do it for one purpose, and that is to educate you, to bring you new themes, new concepts, new ideas, new information about investing in retirement every single show. If the Hollands can help you out, they would love to. If you would like to get a second opinion, make sure that you're not in a trap. You're not in a portfolio that has just duplication beyond belief, because that could hurt if there are corrections on some of these stocks that might be in these mutual funds. Get a review. It's complimentary. There's no obligation. There's no cost to you. All you have to do is call the Hollands at 727-228-6449. That's 727-228-6449. Or go to the website, askthehollands.com. That's askthehollands.com. And all the contact info is on the site, or you can be very quick about it and just click on the link at the very top of the page, click for a discovery call, and then pick the time and date that you'd like to speak with the Hollands. They're happy to build you sample portfolios. They're happy to build you a full retirement plan that they think would work best for you, including tax planning. If you're not working with somebody that absolutely integrates tax planning into your investment strategy and full retirement plan, well, that's a massive element that's missing. Call the Hollands. Again, complimentary, no obligation, no cost to you. There's no commitment. Just call and have a conversation. Ask some questions. 727-228-6449 gets you through to Steve and Elizabeth Holland at the Holland Group Retirement Wealth Advisors here in the Tampa Bay area for over 33 years, since 1993. 1993. Wow. I mean, that's a year before I started my radio career.
Oh, I thought you were going to say before you start walking.
Oh, no. No, I was walking quite some time before that. All right, let's move on here in our first half hour before we have to bring the first half hour to a close. Let's talk about the illusion of diversification. Steve?
Okay, MJ, here's the trap. Investors want to own maybe 5 or 6 different mutual funds, and instantly they think, okay, I'm done. I'm diversified. I'm doing great.
So to answer MJ's question, because this is what I hear from our listeners. You guys talk about all these big, different types of funds, and you talk about all this different type of concept. So I'm going to explain exactly what the illusion of diversification is. So it occurs when the investment portfolio appears diversified, holding multiple funds or asset classes, but is actually concentrated in the same underlying risk, stocks, and sectors. So what does it mean? It's just concentrated with the same type of stocks. So frequently what happens is that it overlapping one another, all the holdings, and this is something that we see and we make a difference on it. Here's where it really, when you peel back the onion, like most of people say with you, Steve, you find the same old stocks. You see 25% in Apple exposure, 20% in Microsoft. You see, there's heavily in tech stocks, and these are the things that
heavy
we
tech
look.
Concentration. Yep.
Yeah, and you have told many people, all of that is just an illusion because you're not fully diversified.
Yeah, you're definitely not, because what's going to happen when the tech sector sneezes, the whole portfolio catches a cold. We saw
that
this.
sounds disgusting.
It's very true. It spreads very, very fast. And we saw this first week of February when the NASDAQ went into the red. For those of you not really up on that term, the NASDAQ is a tech-heavy index that operates entirely through computerized dealer-based systems rather than a physical trading floor, that you see on TV or you see in the movies. It's pioneered by modern high-speed trading, and everyone turns to it, and everyone wants to beat the NASDAQ and beat the S&P 500, and that's the problem. People own the same thing, and they're highly concentrated in 10 companies or less.
Did you ever see the piece? It might have been 60 Minutes years ago, maybe 10 years ago, that there are traders that look for even a nanosecond advantage with faster networks.
That's right.
To make their trades faster.
Yeah,
right.
And even like a quarter second, a half second can make a massive difference. And there were ways for companies or big trading floors or big institutional traders to get that just microsecond advantage on making trades. That to me was fascinating.
Yeah, it really is. And guess who's behind all that? The big, fat, and happy Wall Street firms. They're on the cutting edge of all of this and finding out, of course, any single strategy that they can make more from.
The number to call the Hollands, again, folks, is 727-228-6449. That's 727-228-6449. For the Holland Group Retirement Wealth Advisors. They would love you to call them, ask any questions you have. Let them take a look at your current portfolio and retirement plan. Let them give you a second opinion. Let them offer up the plans that they would suggest, and they'll fully explain why they want to make changes. Complimentary, no obligation, no cost to you. Just call the Hollands. 727-228-6449. That's 727-228-6449. When we get back, we'll do the second half hour. We'll continue on this topic because it's crucial. The question, first up, why fund managers can't really be different. Why can't they be? That's next.
Hey, Sean Hannity here. Unless you want to pay more in taxes than you have to, you should pay attention to what I'm about to tell you. As you know, President Trump's tax cuts have been extended thanks to the one big beautiful bill. What you may not know is that right now, right this second, is the time to start taking advantage and locking in lower tax rates. Do you know who can help you get it done? Steve and Elizabeth Holland and their team at the Holland Group Retirement Wealth Advisors. Now, all you need to do is call 727-228-4673. That's 727-228-4673. Now, you don't want your hard-earned money going to Uncle Sam to be wasted. It's your money. Keep more of it. Steve, Elizabeth, and the team at the Holland Group can show you how. 727-228-4673. Don't wait. Find out how you could be saving saving in taxes for retirement with the help of Stephen and Elizabeth Holland and their team at the Holland Group Retirement Wealth Advisors. 727-228-4673.
Welcome back to Retirement Success from the Holland Group Retirement Wealth Advisors. Hey, everybody, it's me, MJ Todd Schnitt, along with Steve and Elizabeth Holland. And today, we are peeling back the onion. We are ripping the Band-Aid off. We're telling you why mutual funds all seem to own the same companies. The next question, the next revelation, why fund managers can't really be different.
Because they're afraid for their job. They're afraid to lose their job. What's that term that everyone uses now? FOMO, fear of missing out, right?
Oh, I thought you were going to say, Jetson, you're fired.
Right. So
Flintstone?
Yeah,
or the Flintstones, Mr. Slate.
Mr. Slate,
yes.
right. Yeah, I remember him. I would say it comes down to mandates, benchmarks, and a real big thing is career risk. If you're a portfolio manager and for the year, let's say last year, you did like 10% per year, you had a 1 year return of 10%. That's terrible.
Yeah.
Now, by itself, 10% sounds great, but when you compare it to the market doing better than 20, not too good at all. So, yes, there is some career risk, a good amount of career risk in this vocation.
And I want to mention this because we haven't mentioned it recently. When we prepare our clients' portfolio and we rebalance their portfolio, what do we say? We get rid of the dogs.
Right, yeah.
What
definitely.
we're really saying is that if the performance of the portfolio manager is poor, we fire them.
Yeah, that's right. And free up some cash.
Yeah.
So
Who let the dogs out? Elizabeth and Steve. All right?
Right. Who let the dogs out?
There you go.
Yep.
So that's
very important strategy.
Yeah, so a fund manager really struggles with this because it truly is different and to be consistently outperforming the market due to structural behavior. Then this is something that we see, economic strenuance that we see that forces them to resemble that benchmark that they aim for to beat.
Right,
But-
which they rarely do.
I'm about to say that, but they really do miss that benchmark.
Yeah.
So this is something that we see quite frequently, and we pay attention to it, and this is why we do, of course, our rebalancing, because we want to get rid of the dogs, not necessarily just saying that as a term, but get rid of the bad portfolio manager who's not performing, and actually relook at the portfolio, re-examine the performance of everything, and see how the portfolio is growing. This is something that's really crucial for us as a financial advisor. So if you are a valued fund manager and don't own Apple, or the Apple rally is really about 40%, and you look really reckless.
Oh yeah, you look you look like you're about to be unemployed.
Yeah. So even if you had a solid reason, these are the things that we look at in a portfolio. The value fund manager, well, I think they know where their bed is made, pretty much outside their house.
Definitely. So the industry rewards not being wrong alone more than being right differently. The people who own these big mutual fund companies, they don't care. They don't care what your methodology was. They want to know if you got it right. That's what they care about. They want to know at the end of the year if the S&P 500 did 15% and you did 17.5%. They're going to say, "Wow, this is excellent. Good year." It's that simple.
That obviously explains why so many portfolios end up looking, identical. The Hollands are here to help, folks. Please listen to the show, glean these details and absorb, but go a little further and call the Hollands. Investment planning, the full retirement plan. Oh, wait, you don't have a full retirement plan, including tax mitigation and building a tax advantage retirement and portfolio? Well, another reason why you should call the Hollands. Yeah, any manager, any advisor, any broker that poo-poos or, we don't do taxes. I mean, how's that? It's like driving around with a car with 3 tires and the fourth one is gone and you're just scraping metal on 275, near Hillsborough Avenue. I mean, it's just ridiculous. 727-228-6449. That's 727-228-6449 for the Holland Group Retirement Wealth Advisors, or the website has all the contact information at askthehollands.com. Folks, this is your wealth that's on the line. Don't leave a thing to chance. This is a complimentary financial review, no cost, no commitment, but I think you should act now and just make sure that you're in the right position. You don't want surprises later on. Hey, some surprises can be good. This surprise with your finances and your investment strategy and your retirement planning not getting you to and through retirement, that's not a good surprise. Hollands, here to help. 727-228-6449. Let's move on to the fee problem that nobody likes to talk about. Elizabeth?
So we see this on various radio shows that I do listen to. I know, Steve, you listen to them as well. They kind of like to make sure that they tell the listeners out there that, hey, if you're buying an annuity, there's a big problem because there's a lot of fees attached to it.
Yeah.
But the one thing they don't really say is what type of annuity you're buying.
That's right.
And what type of fees attached to it. See, that's the catch or the hook that they use because they want all your money to go under management.
And remember that one show we heard where they were saying these annuities only average like 1.5% per year. You know, every time I sit with a client and I do a portfolio review with them and I look at their annuities and I say, wow, past 5 years, you've averaged 6.9, 7.2, 5.95. And that is the net after the fees. I think that's pretty darn good. Certainly beats the bond market, that's for sure.
Right. So, the financial fee problem is one like that we see and we talk about. The bottom line is it is really the wealth killer that's caused by hidden, systematic, junk fees and advisory fees that are rarely disclosed upfront. And this is something that is a problem with our industry because some of these advisors feel like, I charge you 1%. And when I have had so many people say to me, I can't get a clear answer on what my fees are.
And that's why we call it the verbal dance, right? Because they just verbally dance around and never give the client a really good answer.
And this is why the regulators really target people, the financial groups, so much because they really want you to actually be fair and be transparent with your fees.
Right.
And we don't see the transparency because how many portfolios do we look at every day that people call in and say, I need a second opinion.
Right.
They say, oh my gosh, I can't believe that my advisor didn't tell me I was actually paying 2%. And they hide some of the portfolio fees. They'll say it's 1%, but then in the actual portfolio itself, there are certain mutual funds that's higher.
Right.
In the whole portfolio.
Elizabeth, the average actively managed equity mutual fund, they still charge between 0.6% per year up to 1% per year, with some estimates for total annual costs reaching as high as 1.6 and even higher when you account the transaction cost. And that's pretty hefty. It really is. There's advisors out there, blah, blah, blah. Follow the money. You'll always get the answer. They justify their fees by saying, well, if we bring enough value, we of course, maybe we're a good fit. Maybe we are a good fit for you. And you should, basically they're saying, we charge a lot. We charge too much.
I can't tell you what it really is.
Right. Can't really tell you what they are, but if we bring enough value, maybe we're a good fit. No, you're not a good fit. Keep looking. We'll show you how to really hunt down these implicit, explicit, and explicit fees.
Yeah, if you stay where you are, at some point you might actually have a fit.
Yes.
That's
Yeah.
right.
People want to know. This world today. I mean, you can go on the internet and you can find out anything you want. Whether it's good information or bad information. People. People love AI for this, and they do all kinds of research on it. But I will tell you that for all of these fees that we're talking about, the junk fees I mentioned earlier, this comes as a hidden cost, and it's never disclosed. And of course, what the advisor would say, well, it accumulates over time. that is not the answer because we see it. It is something that you're charging the client way more than you should be charging the client.
And usually it's every month.
Yes.
Right.
So on a $1 million dollar portfolio, that's about $6,000 to $10,000 per year, every year, regardless of the performance. Now, because you're the advisor, you know that you're charging, and you know when you say, "Oh, we charge about a 1%," about a 1% gives you a real good margin to charge whatever the hell you want.
Yeah, and plus they love it. Advisors love it when they get the question, how much am I going to pay you?
Yes.
So they answer the question, well, you're going to pay me 1%. But when you look at that 1%, you have to add on the fee in the ETFs, the fee
Yes.
inside the mutual funds, the trading costs inside, and even the tax liabilities that come along with it. You know, this example, Elizabeth, that you gave, on a $1 million portfolio, $6,000 to $10,000 per year, we're finding it even much higher as far as total fees in excess of $15,000 a year. Over a 25-year retirement, fees alone can reduce your total returns by 20 to 30%. Follow the money, learn how to do this. You will save so much money over the next 10, 20, 25 years.
So you remember Anthony came to us a week ago and said to us, hey, can you do me a favor? I looked at this portfolio and, it's a friend of mine. And basically, he needs to do something because the fees are just so high.
Right.
And we did an analysis for him and his friend. And it was, there is, and it's a very big company. I'm not going to say the name because they're going to love to sue us. But basically,
Right.
it's getting into the portfolio, buying all these funds, mutual funds, there's a fee. To get out of it is a fee. So there's a front end and a back end charge.
Entrance and exit.
And it's about it starts with less than 1%. It goes as high as 2.25%.
Wow.
Right.
So
Yep.
because it's so structural that whatever they put into that portfolio, they're building the portfolio thinking, the client is thinking, wow, this is built and tailored just for me. But what's in the portfolio is really where the fees are really enhanced.
Yep.
727 I'm dying to know which company it is. 727 whispered into my ear, Elizabeth. Just 727-228-6449 gets you through to the Hollands. 727-228-6449, or go to the website. All the contact info is at askthehollands.com. What about just buying stocks directly? Now, some people hear this and say, fine, I'll just buy Apple, Microsoft, Amazon, NVIDIA, whatever, by myself.
Well, we see that, right, Steve? I mean, that's what I was talking about earlier.
Yep.
I have a portfolio that's doing really well, and I'm managing it. And we mentioned the same thing you just mentioned. Those were the stocks.
Right. Yep. Yeah. We definitely do a lot of individual stock ownership for clients because the expense ratio in Apple, in Microsoft, in Amazon, in any stock, the expense ratio is 0. Now, the big question is, but is there a ticket charge? When we buy for the clients, when we sell for the clients, is there a ticket charge that the clients pay? At most firms, the answer is yes. Here at the Holland Group, the answer is no. You do not pay a ticket charge. You pay a straight fee, and we'll be happy to go over that with you. So, this sounds very logical until behavior enters the room. And what I mean by that, Elizabeth, of course, is you've got these investors out there with limited experience, and they're buying these stocks on their own, and they don't realize that even though Apple and Microsoft and Amazon and all the other companies that we buy and sell, they're quality companies, they're mega large, and they can have some serious swings. Do you know that the price of Microsoft this year had over a 50% swing? And a lot of people don't realize that. And so if they put in, say, $50,000 and they say, oh, my gosh, it went down to $25,000, they're probably going to want to sell. So behavior. When behavior enters the room, that's when most of the time we have a problem.
Yeah, wasn't recently Microsoft the victim of a massive hit, a couple of weeks back? Some earnings came, they missed something, or there was like I just remember that Microsoft in one afternoon, I thought, lost like 400 billion in market cap.
Right.
Yeah.
Right. Yeah. There's three that we're keeping a very, very close eye on. One is Microsoft. One is Salesforce.
Oh, yeah,
and,
Salesforce.
And ServiceNow. So these are three companies, software companies that have gotten beat up really, really bad. And there's a lot of people out there that say, yeah, it's a little bit too much. These companies are doing quite well, and they're going to be a big part of AI going forward. And quite honestly, I think those three companies plus many others may be a very good deal right now. I don't have a crystal ball that works, but they certainly may be.
I just did a Google search and found what I was looking for. This was on January 30th, 2026, short time ago. Microsoft stock is flat the day after sinking 10%. Biggest decline since 2020.
Wow.
Happened at the end of January, fell 10%, and it wiped 357 billion off their market capitalization.
Yeah.
And the reason why, because the company's cloud computing business was growing just a little slower than expected.
Right. And the cloud business, so same thing with ServiceNow. And you can look at ServiceNow. The ticker is NOW, not a hard ticker to remember, but you look at that stock as well. It's done very, very well over recent years. We've done very, very well with it. But in the past 3 to 6 months, oh boy, it's gotten beat up quite severely. So owning individual stocks, Elizabeth, that can be a problem, right?
Yes, we've seen it for sure. So, Steve, when we talk about this, we talk about individual stock ownership, increase in market time and risk dramatically. People, like you mentioned, they panic, and what do? They sell. They chase the headlines. This is something that we see. It's very emotional. When it comes to people and the money and the marketing of their stocks, they feel like I could do this better if it's not managed by a professional.
Right.
And we have seen people, and they've said it. I have done very well with my stock portfolio. But then again, it's almost the same thing over again. But here's where the emotional part comes in. When the stock goes down and there's a panic, they call us and say, I think it's time for me to hand over the reins to you because I can't do this anymore. I just can't do it. It's too much for me. It's really acting on my nerves. It's too much for me to see my portfolio, up and down and all that stuff. Well, maybe you shouldn't be managing your own portfolio. Give us the opportunity to do that for you. Let us show you what the difference is going to make in your portfolio. We'll be very transparent on your fees, like we just mentioned, because most advisors out there are not.
Right. This is so much fun to manage money in a bull market, right?
Yes.
Everyone is having a great time. Everyone's making money. But when the market turns on them, they say, whoa, maybe I don't know what I'm doing. Happens every time. Every single time. Studies show individual investors underperform the market by at least 3 to 4% annually, largely due to, you mentioned it, emotional decision making.
Yes.
And that's pretty staggering when you throw a numerical figure to an abstract thing like emotions. I mean, it's just, it's a train wreck, and it's getting worse.
So I have to mention this. We don't have an emotional clients who calls us. When last did that ever happen, Steve?
Well, it doesn't really happen because, again, it's the conversation that we have up front. We tell them what we do. We tell them what we don't do. And we've our 3 golden rules. We will not market time. We will not track record invest. And we will never gamble and speculate with our clients' wealth.
What does a financial advisor actually add? I think this is very important to touch on this.
So as I just mentioned a few minutes ago, this is what we've been doing for like almost all our lives, really. I mean, I have a lot of experience. Like, I won't even tell you how much experience I have in it, years-wise. It's over 30 years experience into this financial business. But so do you, Steve. But I think I started with an equitable life in my early 20s, and that's where I met you. But to use a financial advisor is a real value because, we don't just stock pick. That is not what we do here. We build wealth. We build retirement wealth for our clients. Just if you want to look for stock picking and what's the best stocks, well, you know what? Ask AI, and maybe they will not tell you either.
Call that firm you were going to tell MJ about, the firm that you didn't want to mention on the radio. MJ, I found it in Elizabeth's notes. It's a partnership. Yep. They're called Dewey, Cheatham, and Howe.
Yeah.
No, so... Yeah, you know, when you talk about hiring a financial advisor, I think it boils down to this: exposure analysis. The detailed analysis that we provide, showing clients, as you mentioned, Elizabeth, peeling the onion way back, showing them not only what they have, but where they're headed if they don't make changes. The next thing would be fee efficiency. I often say that I'm kind of like a personal trainer. My job is to get our clients lean and mean and to cut out some of the fat inside their portfolio. You don't need to have 35, 40, 45,000 individual holdings inside your portfolio. The next one would be behavioral coaching. And again, this is the conversations that we have up front, coaching the client and showing them, okay, some of your expectations are a little bit out there. Your bucket list, that may be a little bit too expensive. You might want to cut that back a little bit. Behavioral coaching is very, very important in the relationship in the beginning and throughout the entire relationship. Also, risk alignment for retirement income. There are too many financial advisors out there that just think, hey, when you need income, we'll just take a distribution from your portfolio. No problem. You'll be fine. And you need a lot more than that. You need a written strategy.
So a good financial advisor doesn't just talk about, what you own, right? So it's really not about what you own. What they should be talking about is why, how much, and what happened if the market drops 20 to 30%. What are you going to do?
Ah, right. Excellent point.
So the translation is fewer surprises, fewer emotional decisions. Ladies and gentlemen, build a smarter portfolio. The Hollands are here to help. It's not about avoiding the big companies. It's about balance, purpose-built income strategies, tax-aware positioning, non-correlated assets, lower internal costs. The Hollands will work with you on all of this. They'll build you a portfolio for investment strategy to bring you investment income every month, the full retirement plan. So if today made you wonder whether your portfolio is truly diversified or just diversified by name, that's a conversation worth having. Call the Hollands, 727-228-6449. That's 727-228-6449 for the Holland Group Retirement Wealth Advisors, or the website, askthehollands.com. That's askthehollands.com. Has all the contact information. If you missed any portion of the show, you can catch the Retirement Success podcast. It's available on all major platforms. Don't forget the TV show, Retirement Success, on Channel 10, Sundays right after Meet the Press. That's Tampa Bay's 10 on Sundays at 11:30 a.m. Folks, we'll see you next time on Retirement Success. If you have some questions that you'd like answered, it's just an email away. You can go to askthehollands.com or text the word retire to 474747 and ask your question. And Steve, Elizabeth, and Alicia will be happy to answer your questions.
Tampa Bay, this is Alicia Holland, DiBernardi here, advisor with the Holland Group. We are answering your question of the day, and I have Elizabeth Holland with me.
I am here with you, and I love being here with you. You know why?
Why?
I'm away from my desk working.
Oh.
But this is work too. But this is not really work. This is fun. This is play.
Fun.
Yeah. And I love when our clients or our listeners, our viewers reach out to us and they want us to give them a quick answer. And this is why we do these questions, because it's a quick answer. It's about 4 to 5 minutes. But the real deal, if you want to have a more comprehensive conversation, is to reach out to us.
That's right. Just real quick before we dive into this question, it's funny that you mention you like recording right now and answering these questions because you're away from your desk.
Yeah.
But the irony is we're positioned right in the front of our building. So anyone that walks through the front door, they could literally look through the radio room window and see us. So we're easily found.
Yes, that's true. So there's no hiding.
Exactly. So our next question, it comes from Eileen from Wesley Chapel. And Eileen wrote into us and says this: My husband and I both have Roth IRAs. Should we keep contributing even after retirement, or are there better places to put our money?
Okay, so I always love the fact that you can do, Eileen, that's a great question, and thank you for taking the time and reaching out to us and wanting to know this answer. So I always love the fact that you have a Roth IRA. I'm not sure how old your Roth IRA is for you and your husband. Hopefully it's over 5 years, and because now after 5 years, Eileen, it is tax-free and the growth is tax-free. And we love the word free when it comes to tax-free and growth in your portfolio tax-free.
Yep.
Now you mentioned, should you keep contributing even after retirement? Well, here is the problem with that. You are not able to contribute to a Roth IRA when you retire because you do not have earned income.
Right.
So that is so important for you to know. Now, earned income is just making sure that paycheck is there coming in, you're working, you both, it's the both of you. If one of you was still working, then whoever is still working can have, they can definitely contribute to a Roth IRA, but that's who needs to have the earned income. Now, even after you retire, well, yeah, after you retire, that's a done deal. But if you can continue now and you're still working, try to put as much as you can in your Roth IRA. Now, is there a better place to put your money? Well, first we need to know what other money you have. What do you have and how you invested? For the both of you, what ages are you in reference to close to retirement, or do you have, are you still accumulating your money?
So, Eileen, I wonder if the verbiage you're using when you're saying should we keep contributing, maybe you're thinking of, how am I still funding this Roth IRA even when I'm not working? And perhaps she's thinking about a Roth conversion and is just verbalizing it differently.
Yeah. Oh, could be, but that's the conversation.
Yes, exactly. But that's a great question, Eileen. Thank you for sending that in. And thank you, Tampa Bay. Keep those questions coming in.
Hi, it's Glenn Beck. Let's face it, these are uncertain times. We're bombarded with news of political chaos, economic instability, and a world that feels more unpredictable than ever. I talk to so many people who are wondering, what does all this mean for my retirement? Here's the truth. You can't afford to leave your financial future to chance. That's why you should talk to Steve and Elizabeth Holland and their team at the Holland Group, Retirement Wealth Advisors. I've known Steve and Elizabeth for many years. They are people you can trust. I trust them, and they understand the challenges we're facing and know how to help you protect what you've worked so hard to build. They help people just like you create a retirement plan that's built to weather the storm. No cookie-cutter solutions, just honest help from a team that truly cares about your future. Don't let the chaos rob you of your retirement. Call Steve and Elizabeth Holland and their team at the Holland Group Retirement Wealth Advisors now. 727-228-4674. That's 727-228-4674. Take control of your financial future today with the Holland Group.